When you think about the giants of finance, Blackstone is right at the top. They're the undisputed king of alternative assets. But for an investor looking at the stock today, it's a real puzzle. And the core question is this: what kind of company are you actually buying? Let's unpack that.
Okay, first, just try to wrap your head around this number. That is $1.2 trillion in assets under management. It's a figure that's so massive, it's almost hard to comprehend. And what it means is that Blackstone is by far the largest alternative asset manager on the entire planet. They absolutely dwarf their closest competition.
And that incredible scale leads us right to the central debate for anyone looking to invest. Has Blackstone become this steady, predictable growth machine that you can just buy and hold forever? Or is it still, at its heart, a cyclical company that really only thrives when the markets are hot? To even begin to answer that, we've got to pop the hood. We need to understand how this company actually makes its money. Blackstone's entire business model is built on this powerful engine they call the Blackstone flywheel. So the first part of that engine is something called fee-related earnings, or FRE. The easiest way to think about this is like a subscription fee. For managing all that money, that $1.2 trillion, Blackstone just collects a fee. It's stable, it's recurring, it's the high-quality, predictable part of their business. Then you have the second part, distributable earnings, or DE. Now, this is the metric that Wall Street really obsesses over because it's what determines the dividend that gets paid out to shareholders. It takes that stable FRE we just talked about, but then it adds in these highly profitable, but also highly volatile performance fees. These are the giant paydays Blackstone gets when they sell one of their investments for huge profit. So let's just boil this down because this is the most important thing to get. You've got two different companies living under one roof here. The FRE is like a predictable software as a service or SaaS business. The DE, on the other hand, well, that's the hitter business. It's all about timing the market. Understanding the split is the key to everything. All right, now that we know how the engine works, let's get into the fun stuff. Let's build the bull case, the argument that Blackstone isn't just big, it's a truly unstoppable growth machine. Now, this is where it gets really interesting. Take a look at these growth numbers. In the most recent quarter, that stable, recurring FRE, the quote-unquote boring part of the business, grew by a massive 31%. That's actually faster than the more cyclical DE. This shows you exactly what Blackstone's strategy is. They're making the high-quality, predictable part of the business their main growth engine.
So what's behind this shift? Well, the single biggest factor is a little thing called perpetual capital. We're talking about almost $500 billion in assets that, unlike old-school private equity funds, don't have an expiration date.
And this is how you build a fortress for investors, because this capital is permanent, right? It's not going anywhere. It just sits there generating management fees pretty much indefinitely. It means almost half of Blackstone's core revenue is now insulated from those boom and bust fundraising cycles, which just makes the whole business fundamentally less risky. And this entire strategy is built on a foundation of just insane scale. I mean, look at this chart. It really puts it into perspective. At over $1.2 trillion in assets, Blackstone isn't just beating its peers, it's playing a completely different sport. This scale gives them a competitive moat that's almost impossible for anyone else to cross. And with that kind of scale, they get to plant their flag in all of the biggest growth trends in finance. They're leading the charge to bring these complex private investments to regular wealthy individuals, which is a massive, untapped market. They're beast in private credit, basically acting like a bank for companies that traditional banks won't touch. And of course, they are pouring billions into huge long-term trends like AI infrastructure and the green energy transition. The bulls see these as powerful tailwinds that will last for a decade or more. Okay, that all sounds pretty great, right? An unstoppable machine. But hold on, we have to flip the coin and look at the other side of the argument. This is the bear case, and it says Blackstone is priced for perfection right when it's sailing into some serious headwinds. The number one problem for the bears is this thing the industry is calling the exit logjam. Basically, with interest rates so high, it's just really hard for firms to sell the companies they own for a good price. And that means across the whole industry, there's a record $3.2 trillion in assets just stuck. This logjam directly chokes off those big, juicy performance fees. And for Blackstone specifically, this logjam has created a huge backlog. The company is sitting on $6.6 billion in unrealized gains. That's money they've technically earned on paper, but they just haven't been able to collect it in cold, hard cash yet. Now, the bulls look at that 6.6 billion and they see a coiled spring, right? It's just waiting to unleash this flood of profits the second the market thaws. But here's the bear argument. They say, yeah, we see the coiled spring too, and so does everybody else. The market already knows this money is coming. The stock is already trading at a high valuation, which suggests all of that future good news might already be priced in, leaving very little upside for anyone buying today.
And it's not just that. The bears have a whole list of other worries. The firm still has significant exposure to the struggling commercial real estate market. The whole business model gets tougher if interest rates stay higher for longer. And here's a new one. Their success in attracting everyday retail investors actually creates a new risk. What happens if these less experienced investors panic during the next market downturn and all try to pull their money out at once? So, you've got the unstoppable machine on one side and a business priced for perfection on the other. This brings us to the verdict. How can you, as an investor, cut through all this noise and make a clear decision?
Well, I think the best way to frame this is to see Blackstone as two completely distinct businesses that are just bolted together. You've got the SaaS business, driven by those steady, high-quality, fee-related earnings, and then you have the options business, driven by those wild, high-upside performance fees, which is basically just a huge bet on the health of the market. And at the end of the day, your decision really comes down to a single choice. Which one of these two businesses are you actually betting on? Do you value the stability and the predictable growth of that SaaS engine? Or are you really just betting on that massive upside from the options business when the markets finally turn around? Let me put it another way. When you buy a share of Blackstone stock today, you're getting a package deal. First, you get that stable, growing, SaaS-like business. That's your foundation. And second, you also get a call option, basically a lottery ticket with huge potential upside on a market recovery, paid for by that $6.6 billion coiled spring of performance fees. And that brings us right back to the essential question we started with. Blackstone has successfully transformed itself into a hybrid. It's part stable fortress, and it's part high-upside market hitter. So the trillion-dollar question for you, the investor, is, which one of those two companies are you actually buying?